Hello everyone, welcome back to another video. If you're new to this channel, my name is Farhan and I help accounting students like you ace their exams. What we've got here today is a practice question where you will be preparing the accumulated depreciation ledger account. You can check some videos that I've uploaded in the past with regards to this topic where we have done the same thing many times, and with practice you can only get better with this specific ledger account. So you can see the question on the left hand side of your screen, and on the right hand side we have all the workings which I'll explain and go through step by step. What I need you to do now is follow through for an excellent understanding. So let's begin. Sam Trading bought two machines on 1 January 2014 for $15,000 each by check. The business depreciates machinery at 20% per annum using the reducing balance method. A full year's depreciation is provided in the year of purchase and none in the year of sale. So based on the first two paragraphs, we understand that the business purchased two assets on 1 January 2014 for $15,000 each. All right. So altogether, the business paid $30,000 for two assets. And these assets were purchased using check, which means the funds available in the bank account. The business depreciates machinery at 20% per annum using the reducing balance method, and a full year's depreciation is provided in the year of purchase, and no depreciation is provided in the year of sale. On 1 November 2016, one of the machines was sold for $8,000 by check. So this is referring to the sale of a non-current asset, also known as the disposal of a non-current asset. On the same day, Sam bought another machine for $30,000 by check. So in this paragraph, first we have sold one machine, and then on the same day we have also bought a new machine. The business ends its financial year on 31 December. So if that is the case, it means that the business financial year always starts on 1 January and ends on 31 December, which are the 12 months. Okay. The requirement of the question is to prepare the ledger accounts for the year ended 31 December 2016, all right, for the accumulated depreciation of machinery account. So I need your attention now to the workings on the right hand side, and let's see what's going on. So first of all, we have already established that we're working with a business where the financial year always starts on 1 Jan and ends on 31 December. Okay. Now, the two assets that we purchased, as mentioned in the very first line of the question, were both purchased on the 1st of January 2014 for $15,000 each. Okay. So let's look into the depreciation for the first year. So as we understand, the two assets were purchased on 1 January 2014, which also happens to be the beginning of the financial year of the business we're working with. So year one for this asset will therefore be from 1 Jan 2014 until 31 December 2014, which are the 12 months that the business operated in 2014. Okay. Now, based on the requirements of the question, we understand that we are to apply a full depreciation in the year of purchase. So year one is when the machines were bought, so therefore they have to go through a full depreciation. We will calculate the depreciation now for one of the assets only, just to simplify our calculations, and later we will multiply our numbers by 2 to arrive at the total depreciation for both these assets. The reason we want to do this is because we don't want to make any mistakes and avoid complications for now. So let's see what's going on. So I'm calculating a full depreciation in the year of purchase, which I'm doing by simply multiplying the given percentage with the cost. Okay. And the given percentage in the question is 20%. The cost for one of these assets is $15,000, which gives us a full depreciation of $3,000 for one asset. Okay. Now, using the reducing balance method, I always recommend that you also calculate the net book value at the end of the financial year. So we want to find the net book value at end of 31 December 2014. The net book value at any given point in time is the difference between the cost and the accumulated depreciation. The cost for one of these assets is $15,000, and the accumulated depreciation refers to the depreciation that we have so far since the date of purchase, which is only the depreciation we have derived for the first year, and that is $3,000, and that gives us a net book value of $12,000. Again, this is only valid for one asset, okay? So let's calculate these numbers for two assets. Since we know the depreciation for one asset is $3,000, and given that both these assets were purchased on the same date of 1 January 2014, and each of these assets also costed the same of $15,000, and also each of these assets are to be depreciated using the reducing balance method at 20% per annum, what we can do now is, if you want to find the total depreciation expense for the first year starting 1 Jan 2014 and ending 31st of December 2014, then you just simply take the depreciation for one asset, which is $3,000, and multiply by 2 to get the total depreciation for two assets, and that is $6,000. Okay? All right. All right, so I believe you're clear, and if that is the case, now we can move to the second year. So year 2, as you understand, will now start from 1 January 2015 and end on 31 December 2015, which are the 12 months of operations of the business for SAM Trading. Now, using the reducing balance method, when you want to calculate the depreciation in the second year and onwards, you find the depreciation by multiplying the given percentage with the net book value. Now, the given percentage, as you already know, is 20%, which is the depreciation rate. The net book value as is $12,000. Obviously, we are calculating the numbers again for one asset only. So $12,000 is the net book value which we had at the end of the first year of usage, if you recall. So I'll just scroll back up a bit. So you can see here the net book value that we had at the end of previous year, which was $12,000. So the depreciation is therefore calculated by multiplying 20% with $12,000, which is $2,400. And again, we understand that this depreciation is valid for one asset only. Then I want to find the net book value at the end of year 2, which is at the end of 31st of December 2015. Now, we understand the formula for calculating the net book value at any given point in time is the difference between the cost and the accumulated depreciation. But since we already know the net book value at the end of the first year, which was $12,000, now that we have a new depreciation expense which we have calculated for the second year of usage, we could just subtract this depreciation expense from the net book value which we already had at the end of the first year, which would completely make sense. So we have got $12,000 at the end of first year in terms of net book value, and now we are subtracting the new depreciation expense of $2,400, which we had derived for the second year for one asset, and that gives us $9,600 as the net book value at 31 December 2015. And again, this is only valid for one asset. All right. Now, if I want to find the total depreciation expense in year 2 for both these machines combined, okay, given that they're both similar in characteristics and nature, we just simply multiply 2,400, which is the depreciation we have derived for the second year, multiplied by 2, and that is $4,800, okay? All right. Now, I have a question. So what's the accumulated depreciation that we have got so far since the day of purchase? Accumulated depreciation at any given point in time stands for the total depreciation that we have for the specific assets since the day they were bought. The specific assets that we're talking about now is the machinery, all right? These machineries were bought on 1 Jan 2014, and currently we only finished working up to year 2, which is end of 31 December 2015. So the accumulated depreciation from 1 Jan 2014 until end of 31st of December 2015, which are the 24 months of concern, are $6,000, which we calculated in year 1. Do you recall? It was $3,000 for one asset. Two assets together had a total depreciation expense of $6,000 in year 1, plus an additional $4,800, which is $2,400 for one asset. and $4,800 for two assets combined in year 2, right? So 6,000 plus 4,800 gives us $10,800 as the accumulated depreciation for the 24 months since the day of purchase on 1 Jan 2014. Okay. Now, why do we need to know this? As you know, the requirement of the question is to prepare the accumulated depreciation ledger account for the year ended 31st of December 2016, which means we are concerned about all events from 1 Jan 2016 until end of 31st December 2016. Okay? Now, how does this accumulated depreciation we calculated here at 31st December 2015 fit into all this? Now, this is the accumulated depreciation as we understand at 31st December 2015, which will become the opening balance in the accumulated depreciation ledger account on 1 Jan 2015. Sorry, 1 Jan 2016, okay, which is the new financial year I'm talking about. All right. Now, I'll take your attention to the ledger account. I'll just bring that up one sec. Here. So here I've got the accumulated depreciation ledger account, all right? And you can see that 2016, 1st of Jan, I've got the opening balance of 10,800 on the credit side because accumulated depreciation of machinery by default is a contra asset account, and all contra asset accounts by default should have an opening balance on the credit side. What's the meaning of a contra asset account? A contra asset account is an account which records the reduction for a relevant non-current asset account. The relevant non-current asset account in this case is the machinery account. So whatever reduction, whatever depreciation our machinery goes through will be recorded or stored in a separate account, which is the accumulated depreciation account. And this is a contra asset account because this account mainly records the reduction that we incur through depreciation for the machinery. Okay, so accumulated depreciation should always have a credit opening balance, and by default it means that whenever it increases we credit it and whenever it decreases we debit it. So that's why on 1 Jan 2016 the opening balance is reported on the credit side of 10,800, which gives us a net balance of 10,800 credit to begin with on 1 Jan 2016. Okay, now I'll take your attention to the third year of calculations. All right, so just bear with me for a moment. Remember that we were using the reducing balance method because I made some changes in the question before which this don't have. Okay, now the third year of usage would be from 1 Jan 2016 until end of 31st of December 2016. Okay, and in between this 12 months of concern for which we are actually prepared the accumulated depreciation ledger account, we've got many events that have occurred. Firstly, we've got the sale of one machine on 1 November 2016. Okay, and based on the company policy, we do not apply any depreciation in the year of sale. Okay, so this machine which we have sold goes to have no depreciation in the year of sale. Now, the net book value for one of these machines from year 2 that we had was 9,600. So if you recall, the net book value at 31st of December 2015 was 9,600 for one of these machines, right? Which is obviously the case here for the machine which we have sold. And the question mentions that on 1 November 2016, one of these machines was sold for $8,000. So you can see the net book value is 9,600 and we have sold the machine for $8,000. What does this mean? The net book value basically refers to all the economic benefits available for consumption, which means the machine still had $9,600 worth of value left, but we end up selling it for less at $8,000, which means we made a loss. Okay, so this is not a gain as you can see here. So we made a loss on sale because we sold it for less than what it was actually worth. We sold it for $8,000 when the value remaining was actually $9,600, which means we have sold it for $1,600 loss. Okay, all right. Then, as we already are clear with the fact that no depreciation is to be charged for the sale of this machine, let's move forward to the other old asset that we still had left. So if you recall, we had two assets originally, and one of them has just been sold, which means another old asset still remains. And this old asset which remains, as we already know, has the same characteristics as the asset which we have sold, because they are the same machines bought for the same price on the same date, depreciated at the same rate, and using the same method. Okay? Now, the net book value for this other old asset is also 9,600, right? And the depreciation is calculated by multiplying the given percentage with this net book value, because we're using the reducing balance method of depreciation, which gives us a depreciation of $1,920. Okay? All right. So what about the new asset that we had purchased? If you read the question again, which I'm just about to highlight in green, on the same day, which is 1 November 2016, another machine was bought for $13,000 by check. Now, based on the company policy, a full depreciation is applied in the year of purchase for new assets. So how do we apply a full depreciation? Use the given rate of 20% and multiply it with the cost of $13,000, which gives us a full depreciation of $2,600. Okay? Now, that's all the calculations needed so far. Now, what's the total depreciation expense in year 3, which starts on 1 Jan 2016 and ends on 31 December 2016? Is $2,600 for the new asset that which we had just purchased, plus an additional $1,920 for one of the remaining old assets. Okay? The asset which we had sold obviously has no depreciation, but one of the old assets still remains in the books, and that has a depreciation of $1,920, which is added with the depreciation of $2,600 for the new asset which we purchased. Altogether, it gives us $4,520 as the total depreciation expense for the remaining assets. Okay? And this amount is to be transferred to the accumulated depreciation ledger account. So how do we make the transfer? How do we prepare the journal entry to record this depreciation expense which we have got at end of year 3 on 31 December 2016? So every time you've got depreciation expense which you incur for your business, the entry is always the same. You debit the depreciation expense account, which in this case, to be specific, is the depreciation of machinery account. So when we're debiting depreciation expense here, our expenses are going up, and expenses by default, when they increase, are always debited. So that's why it makes sense to debit the depreciation of machinery account, which is an expense account. And the amount is $4,520. At the same time, we have to credit accumulated depreciation of machinery account by $4,520. Accumulated depreciation of machinery is a contra asset account, which means this is an account which records the reduction for a relevant non-current asset account. And the relevant non-current asset account in this case is the machinery account. Accumulated depreciation, since it records the reduction of assets, therefore is classified as a contra asset and should always have an opening balance on the credit side, and by default is always credited, which also means that when it increases, it is credited. Okay? All right. So every time you want to record the depreciation expense incurred in your business, which is typically at the end of the financial year, and in this case, it's at 31 December 2016, you debit the depreciation expense account, which in this case is a depreciation of machinery account, to be specific, by $4,520, and you credit the contra asset account, which is the accumulated depreciation of machinery account, by $4,520. Now, why did I want you to know this journal entry? Because it will help us prepare the ledger account. Now, so we understand that the accumulated depreciation account is being credited here, right? This means that in the ledger account for accumulated depreciation of machinery at 31st of December, the $4,520 has to be recorded on the credit side. Okay? And the relevant cross-reference that we will include in the details column is the depreciation of machinery. And as you can see, we have got two credit balances so far, which will obviously get added with each other and give us a final balance of 15,320 credit. Okay? So 10,800 plus 4,520. So 10,800 plus 4,000 is 14,800 plus an additional 520, which is 15,320. Okay. Now, what do we do next? We transfer this as the opening balance in the next financial year starting 1 Jan. And as you understand, accumulated depreciation is a contra asset account, which means by default, the opening balance is always going to be on the credit side. So as you can see, 2017 1 Jan, opening balance, which is balance brought down, recorded on the credit side. Okay? All right. Now, I believe that's all for today's lesson. We have also calculated the loss on sale as we were doing our calculations. Okay, and remember, this is a reducing balance question, not the straight line, because I've already made the error in the previous question, which I didn't show, so I had to change it along the way. But yeah, so I recommend you look into the other videos which I've got on accumulated depreciation calculations for multiple years and also the preparation of ledger accounts for multiple years. Very soon, I'll be uploading a video on preparing the sale of asset ledger account as well, and also some videos on allowance for impairment of trade receivables. Okay. Now, if you want me to help you and prepare you for the exams at the end of the year, there is a link in the description to book a free Zoom call with me. My sessions are all online. You must bring your parents, and we can discuss how we can help you prepare for your exams at the end of the year and help you get an A1. So with that being said, I'll conclude today's lesson, and I'll see you in the next one.